Bitcoin is pushing new highs, trading around the $124,000 mark. For the last few weeks, it's been a total knife fight between wild euphoria and sheer terror. After finally smashing through its old all time high of about $123,500, the market did what it always does. It delivered a sudden, gut wrenching dip that sent billions in leverage bets straight to their graves. And right on cue, every crypto influencer and their dog is flooding your timeline with three little words: buy the dip. It's the rallying cry of every bull run. It's the mantra that has literally made people millionaires. But this time feels a little different, doesn't it? We're in uncharted territory at prices that seemed like a fantasy just a year ago. The stakes have never been higher. So, is this simple advice a golden ticket for the home stretch of a historic bull run? Or is it a catastrophic trap laid by smart money to dump their bags on you one last time before the party's over? This isn't just another video telling you to blindly throw money at the screen. We're going to rip apart the data. We're going to dissect the arguments for and against this dip. And by the end, you'll have a clear, actionable game plan. Welcome back to Crypto Axiom. I'm Alex, and we are the rational core of the crypto market. Let's get to it. So, what the hell just happened? To figure out if we should buy this dip, we first need to understand what caused it. It wasn't just one thing, it was a perfect storm of factors that cranked up the pressure. First, let's talk about the price itself. Bitcoin soared, setting that new record high. The market was absolutely euphoric. The crypto fear and greed index was practically glued to extreme greed. Social media was a mess of rocket emojis and wild predictions of $150,000 by Christmas. It's classic late stage bull market behavior. Whenever you have that much one sided optimism, the market gets incredibly fragile and ripe for a leverage flush. In the derivatives world, open interest, basically the total number of bets on the future price, had swelled into the tens of billions. A huge slice of that came from traders taking on massive debt to bet on the price going even higher. They were leveraged long. All it took was a small nudge, just a bit of profit taking from bigger players to push the price down just enough to trigger a liquidation cascade. We saw hundreds of millions of dollars in futures positions get completely wiped out, mostly these overly optimistic long bets. This liquidation cascade is what turns a little dip into a violent crash. It's the market cleansing itself of excessive greed. But it's more than just market mechanics. There are whispers in the wider economy. We've seen signs of stubborn inflation that just won't go away. And there's always the backdrop of geopolitical uncertainty. On top of that, there are reports that a potential US government shutdown could sideline key regulatory decisions, including the approval of even more crypto ETFs. This kind of news, even if it's temporary, can spook investors and give them a perfect excuse to cash in some chips after such a huge run up. And finally, we have the whales. On chain data has shown some fascinating and slightly nervy movements. We've recently seen a spike in average dormancy, a metric that shows old, sleepy Bitcoins are starting to move. Analyst reports highlighted massive transfers from wallets that had been dormant for years, with some single movements valued in the billions. When old coins move, it can be a sign that early adopters, the folks who bought Bitcoin for pennies, are starting to cash out. One analyst even pointed out that the last time one specific whale started selling, Bitcoin's price took a nearly $9,000 nosedive. So, you've got a cocktail of extreme greed, a massive leverage bubble, shaky macro news, and whales starting to wake up. That's the anatomy of the dip we just saw. It wasn't random, it was a violent but predictable reset. The question now is, was this reset the beginning of the end, or just a pit stop before the next explosive move up? To answer that, we have to look at the biggest debate raging in crypto right now, the 4-year cycle. For over a decade, Bitcoin has danced to a surprisingly predictable beat. It's called the 4-year cycle, and it's tied to the halving, a pre-programmed event that cuts the new supply of Bitcoin in half. Historically, this cycle has been the most reliable roadmap for Bitcoin investors. It goes like this: a bear market bottom, a slow accumulation phase, and then an explosive bull run that usually peaks about 18 months after the halving. After that peak, a devastating 80% correction, and the cycle starts all over again. Now, here's the scary part. The last bear market bottomed out in November 2022. The last halving was in April 2024. As of right here in October 2025, we are now roughly 1,051 days into this bull market since that bottom. If you look back at previous cycles, the bull market peaks have historically shown up right around this point in the timeline. Do the math. We are standing in the exact window where previous bull markets have topped out and rolled over into a soul crushing bear market. This isn't just some loose theory, it's a pattern that has held up with unnerving accuracy for 3 straight cycles. If history is our guide, then buying this dip isn't an opportunity. It's suicide. It's trying to catch a falling knife right before it clatters on the floor. The 4 year cycle theory suggests that the massive run we've seen, the push toward $124,000, was the final euphoria phase. This dip then isn't a healthy correction. It's the first tremor of a major trend reversal. Think about it from the perspective of a long term holder who's been through this before. They've seen this movie. They know that after the parabolic run comes the brutal crash. They are the ones whose coins are starting to move, like we saw in the on chain data. They're looking at the calendar and saying, this is my exit. They're selling into the market's excitement, offloading their bags to the new euphoric retail investors who are screaming buy the dip without a clue about the historical context. Plus, technical indicators on the longer term charts, while not outright bearish, are showing signs of exhaustion. The weekly and monthly relative strength index, RSI, a momentum gauge, is deep in overbought territory. It's not at the absolute peak levels of past cycles, but it's high. This suggests that while there could be more gas in the tank, the risk to reward ratio is getting worse by the day. If you're buying here, you're betting on one thing and one thing only: that this time, for the first time in Bitcoin's history, the cycle is broken. You are betting that history won't repeat itself. That is an incredibly dangerous bet to make. The bear case is simple. The clock is ticking, the party's winding down, and this dip is your final warning to get out before the house comes crashing down. Okay, let's take a deep breath and look at the other side of the argument, because there's a powerful data-driven case to be made that the old 4 year cycle is dead. And if it is, then buying this dip might just be the single best financial decision you make this decade. The biggest difference between this cycle and every other one can be summed up in 2 words: institutional adoption. The 2017 bull run was fueled by retail mania and ICOs. In 2021, it was a mix of retail FOMO and early corporate moves from companies like MicroStrategy. But in 2025, the game has totally changed. We're not just dreaming about institutional adoption anymore. It's here. It's a reality. The approval of spot Bitcoin ETFs in the US was the watershed moment. It opened the floodgates for trillions of dollars in institutional capital to flow into Bitcoin in a way that's regulated, insured, and familiar. And it has been flowing. We're seeing record inflows into these products, with reports of over $2.2 billion pouring in during a recent breakout. We're not talking about small-time retail traders anymore. We're talking about the largest asset managers on the planet, like BlackRock and Fidelity, who are now major players in this market. These institutions don't operate on 4 year retail hype cycles. They're buying Bitcoin for their long-term strategic portfolios. They see it as digital gold, a hedge against inflation and geopolitical risk. Their holding periods are measured in years, not days or weeks. This creates a massive, consistent, and relatively price-insensitive wall of demand that has never existed before. One analyst report from K33 Research put it perfectly, stating, "We firmly reject the outdated 4 year cycle framework, arguing that Bitcoin has entered a new structural regime shaped by institutional adoption, ETF integration, and macro policy shifts." This institutional demand is having a visible effect on supply. The amount of Bitcoin held on exchanges has dropped to a 5 year low. That means coins are being moved off exchanges and into cold storage, a sign of long-term holding, not short-term flipping. Corporate treasuries hold a significant and growing portion of the total Bitcoin supply, a dramatic increase since 2020. A massive supply-demand imbalance is forming. Some estimates suggest that potential institutional demand could outstrip the new supply of Bitcoin by a factor of 40 to 1 over the next 6 years. On-chain data backs this up. While some old whales are taking profits, the bigger picture shows that the long-term holder supply is still incredibly strong. Glassnode data shows a massive cluster of nearly 190,000 BTC was bought between $114,000 and $117,000. That zone, which used to be a ceiling, has now flipped into a massive support floor. This suggests that dip buyers are actively stacking sats in this range, soaking up the selling pressure. And while the market feels euphoric, key on-chain metrics like the MVRV score, which helps spot market tops, are high, but haven't reached the peak levels we saw at the absolute tops of previous cycles. This is the bull case. The fundamental structure of the market has changed. The predictable, retail driven 4 year cycle has been shattered by an unprecedented wave of institutional money. This dip isn't the beginning of a bear market, it's a shakeout designed to scare retail investors so institutions can accumulate more Bitcoin at a discount before the next leg up. Projections for the end of 2025 and beyond are still incredibly bullish, with some analysts targeting $180,000 or even $200,000. This isn't a trap, it's the market offering you one last chance to get on the train before it leaves the station for good. All right, this is getting intense. We're at the critical decision point. I've laid out both sides, the historical bear case and the structural bull case. In the next section, I'm going to tell you exactly what I'm doing with my own portfolio and my precise strategy for navigating this dip. But I know many of you want more than just the strategy. You want the specifics, the exact entry points, the stop loss levels, and real-time updates as the market moves. That's stuff I can't cover in a single video. So for those who are serious about this, I share all of that in my free weekly newsletter, the Crypto Axiom Pro Report. It's where I share my personal trade setups, deep dive analysis, and altcoin watch list. There's a link in the description below. It's completely free, no spam, just high quality analysis delivered to your inbox every Friday. Sign up and let's navigate this market together. Now let's talk strategy. So the $1 billion question, am I buying this dip? The answer is a clear yes. But, and this is the most important part of the entire video, I am not backing up the truck and going all in. That would be completely reckless. My approach is all about cautious, strategic accumulation. I believe the bull case is stronger, but I respect the warning signs from history enough to manage my risk like a hawk. Here is my playbook, step by step. First, dollar cost averaging, but on steroids. I'm not just buying blindly. I'm deploying cash in chunks at predefined levels I'm interested in. The first and most critical support zone is the area between $117,000 and $120,000. As we discussed, this is where a huge amount of Bitcoin was recently bought, turning that old ceiling into a new floor. I've already started placing buy orders in this range. If the price holds here and starts to build a base, it would be an incredibly bullish sign. My second major zone of interest is around the $110,000 level. This area was the previous all-time high from earlier in the year and should be strong psychological and technical support. A dip to this level would feel scary, I get it, but it would be a healthy retest of a major breakout zone. I have a second larger chunk of cash ready for this level. My third and final major support area is the 50-week exponential moving average, EMA, which currently sits around $100,000. Throughout this entire bull run, the 50-week EMA has been the ultimate line in the sand. A dip to this level, while painful, has historically been the absolute best buying opportunity within a bull market. I have my largest tranche of capital waiting here, though I think a drop this deep is less likely given the current strength. Second, I have a clear invalidation point. Risk management is not optional. If Bitcoin were to lose that $100,000 level and fail to reclaim it quickly, my bullish thesis would be in serious trouble. It would be a sign that the bears have taken control and that the old 4 year cycle pattern might be playing out after all. Below that level, I'd pause all buying and switch to a capital preservation mindset. Hope is not a strategy. You have to have a line in the sand where you admit you might be wrong. Third, I'm watching for confluence. I'm not just staring at the price, I'm watching on-chain data obsessively. I want to see ETF inflows stay strong. I want to see exchange reserves keep dropping. I want to see active addresses stay high. As long as these underlying signs of network health and institutional demand remain strong, I'll keep buying the dips into my predefined zones with confidence. This strategy lets me participate in the upside while protecting myself from a catastrophic loss. It takes the emotion out of the game. I'm not panic selling and I'm not FOMOing into a bounce. I have a plan and I'm sticking to it. This is how you survive and thrive in a market driven by both insane opportunity and extreme risk. It's a rational, measured approach in an irrational, emotional world. Let's zoom out for a second. It's so easy to get lost in the day-to-day chaos of the charts, the red and green candles that play with our emotions, but the real wealth in this space is built by understanding the long-term trend. And that trend is only pointing in one direction. Bitcoin is no longer a niche internet toy. It has cemented its position as a global macro asset. With a market cap in the trillions, it's in the same conversation as gold and government bonds. Institutional investors who control tens of trillions of dollars are just getting started. Some projections show institutional ownership growing to a substantial portion of Bitcoin's total supply in the coming years. Price targets that once seemed absurd are now being put out by mainstream analysts. VanEck, who has been pretty good at calling market moves, maintains a year-end 2025 target of around $180,000. Longer-term analysts are projecting prices of $200,000 or even higher in the next 12 to 18 months. Some models even predict a value over $600,000 by the 2028 halving as Bitcoin continues to chip away at gold's market share. These dips, these moments of panic and fear, are a feature, not a bug. They exist to shake your conviction. They are the price of admission for potentially life-changing gains. The smart money gets this. They use this volatility to accumulate from people who are driven by fear. Almost every single person who has held Bitcoin for a full 4-year cycle has seen a profit. The key is having the conviction to hold and the strategy to add during moments exactly like this. This isn't just about the price. It's about a fundamental shift in our financial system. It's about the rise of a decentralized, programmable, and scarce store of value that can't be debased by any government or central bank. That's the big picture. That's the revolution you're investing in. When you truly get that, a 10% or 20% dip isn't a crisis, it's a sale. It's a gift from the market. It's an opportunity to increase your stake in what might just be the most important asset of the 21st century. So, we come back to the original question. Is buying this dip sound advice, or is it a trap? The truth is, it's both. It's a trap for the uninformed, for those who go all in with leverage driven by pure greed and FOMO. They are the ones who will get shaken out and financially wrecked. But for the rational investor, for the person who understands the risks, has a plan, and sees the monumental shift happening under the surface, this dip is a profound opportunity. We're at a critical crossroads. The historical 4-year cycle is screaming caution, while the new reality of institutional adoption is roaring with bullish momentum. My money is on the future, not the past. I believe the structural changes in this market are too powerful to ignore and that they have broken the old patterns for good. I am buying this dip, but I'm doing it intelligently with a clear strategy and solid risk management. Dips like these are where conviction is forged. They're what separate the tourists from the true long-term holders. Stay strong, stay rational, and don't let fear dictate your financial future. Now, I want to hear from you. What's your playbook? Are you buying, holding, or taking profits? Let me know your full thesis in the comments below. And if you found this analysis valuable, do me a huge favor and hit that like button, subscribe, and ring the notification bell so you don't miss our next breakdown. Thanks for watching, and I'll see you in the next one.